Zero lag, or non-lagging moving average price action trading approach. By the time you finish this video, you'll know exactly when to enter high probability trade using the non-lagging moving average trend analysis and high probability price action setup. As usual, we'll have plenty of practical examples. The idea is to fully understand this wonderful trading strategy and to make the most out of it. If you want more videos more often, please smash the like button, subscribe, and turn on the notifications bell so that you know exactly when new content is released. A very important point before we start. Everything we discuss in this video can be used for currency trading, stock trading, and crypto, because price action stays relatively consistent across different assets, so we're going to go very in-depth in this video. Trading rules. Non-lagging moving average trading strategy. The following rules are not set in stone. Adapt them to your trading profile. Here, the exact parameters are secondary. Consistency is the key. Trading tools. First, a 240-period non-lagging moving average, or NLMA, for highlighting the macro direction. Second, a 21-period non-lagging moving average, or NLMA, for clarifying price waves with its slope. The zero-lagging moving average or non-lagging moving average is an exponential moving average indicator created by John Ehlers and Rick Way. The non-lagging moving average is an exponential moving average, or EMA, that works very well for tracking price swings. As is the case with the double exponential moving average, or DEMA, and the triple exponential moving average, or TEMA, and as indicated by the name, the aim is to eliminate the inherent lag associated to all trend-following indicators which average a price over time. The idea is, do a regular exponential moving average calculation, but on a delagged data instead of doing it on the regular data. Data is delagged by removing the data from lag days ago, thus removing, or attempting to, the cumulative effect of the moving average. Rules for long trade. First, the 240-period non-lagging moving average is sloping up, or blue line. Second, the 21-period non-lagging moving average highlights higher highs and higher lows. Third, wait for the 21-period non-lagging moving average to start pulling back downwards. Fourth, go long when the price closes above the 21-period non-lagging moving average, or blue line. However, if the pullback goes below the last swing low, or forming a lower low, the setup becomes invalid. Rules for short trade. First, the 240-period non-lagging moving average is sloping down, or red line. Second, the 21-period non-lagging moving average highlights lower highs and lower lows. Third, wait for the 21-period non-lagging moving average to start pulling back upwards. Fourth, go short when the price closes below the 21-period non-lagging moving average, or red line. However, if the pullback rises above the last swing high, or forming a higher high, the setup becomes invalid. These rules offer a focal point for your analysis. But feel free to override them if you have valid reasons to do so. In a nutshell, exercise your discretion as a trader. Valid reasons are often rooted in your price action observations. Next, you'll see examples of it. Trading examples. Non-lagging moving average price action trading approach. Example 1. British pounds United States dollar. Forex trading. Number 1. The 240-period non-lagging moving average was sloping down and pointed to a bearish bias. Number 2. The changing slope of the 21-period non-lagging moving average highlighted a set of lower swing low and lower swing high. It confirmed the bearish market. Number 3. The 21-period non-lagging moving average alerted us to the next pullback here. Number 4. This bar closed below the 21-period non-lagging moving average and triggered a short trade. Number 5. Now, let's focus on this bearish pin bar. If you look beyond the 21-period non-lagging moving average and concentrate on the price action, this bar made a minor higher high. It broke the market structure we needed. However, the bearish pin bar also signaled that the market rejected the bullish attempt. Hence, overall, it was still an acceptable short setup. As you get familiar with this approach, you'll learn that the technical rules are just for guidance. This should be simple enough. Or, in this video, I've included a template with the system that you can simply upload to your chart, and it will automatically plot all these indicators perfectly on your charts, so there's nothing for you to worry about. Get the download link on the description. Example 2. Here, the 240-period non-lagging moving average was sloping downwards, indicating a bearish macro bias. Number 2. Using the waves highlighted by the 21-period non-lagging moving average, we could discern clear lower highs and lower lows. This swing structure supported a downtrend. Number 3. During the pullback that followed, a short setup presented itself as price closed below the 21-period non-lagging moving average. Holding the position until the end of the downswing led to solid profits. Example 3. Losing trade. Number 1. The red 240-period non-lagging moving average highlighted the negative slope, implying a bearish bias. Number 2. The thick blue lines highlighted the lower highs and lower lows, as defined by the 21-period non-lagging moving average. Number 3. During the subsequent pullback, prices closed below the 21-period non-lagging moving average, and we shorted. After stalling for a day, the market reversed abruptly into a bull trend. Let's see if we can figure out why this trade failed. We saw lower highs and lower lows. There were indeed lower highs if we were trading the indicator 21-period non-lagging moving average. But recall that this is a price-based approach, and the 21-period non-lagging moving average only serves to highlight, but not define the market structure. If you look beyond the indicator colors to focus on price action, you'll find that the lower highs were barely perceptible. Most of the candlesticks overlapped with the nearly flat 21-period non-lagging moving average. It was a sign that the 21-period non-lagging moving average's slope was not reliable for clarifying price waves at that point. Hence, a trading range was likely, and the market structure supporting a short trade was weakened. Example 4. This 1-hour chart comes from the Forex market, United States dollars JPY. This example is close to a textbook example. As an exercise, try to compare how the price waves look here with the losing trade, on example 3. The order of analysis is critical. Number 1. Always stay with the trend. Here, the rising 240-period non-lagging moving average pointed to a bullish backdrop. Number 2. The neat 21-period non-lagging moving average waves highlighted a solid bullish structure with a higher low, followed by a higher high. Number 3. This pullback down was orderly. This characteristic usually bodes well for pullback trades. Number 4. The powerful doji bars help you in assessing who has control over the market. Here, the market up above the 21-period non-lagging moving average. These are possible long entries from since then. The price waves are smooth and nice in this example. You can track them easily. Patience is the key challenge. Here are other examples of non-lagging moving average price action trading to fully understand this wonderful strategy and to make the most out of it. To bear in your mind. When you use this trading approach, you are trading price action and not indicators. Look at the example number 3. Do not get lost following indicators like this losing trade. As always, if you learned something new, or if you want more videos more often, make sure you subscribe, click the notification bell, and share this video across your WhatsApp, Facebook accounts, or Twitter to show your support. See you next time.